viewers with regard to all that Ankur is hearing from the RBI. But joining us at this point, Hitesh Suvarna, macroeconomist at JM Financial Institutional Equities, and Sachidanand Shukla, who's Group Chief Economist at Larsen & Toubro, both of them joining us this morning. Let me start with you, Sachidanand. What are you making of the policy? It's an interesting inflection point because the RBI has got upside surprises on both growth as well as inflation. What should therefore the policy stance be? Would that change at all? Do you expect a change with regard to the estimates on inflation and growth? And what would the policy rate be, in your opinion? Very quickly.
Good morning. Thanks for having me. I think it's very clear that the RBI has ample scope for another rate cut looking at the inflation data. And the question is, should they be doing it? So why, in my opinion, is more important than how much and when on rate cut? If you look at the RBI, it is in a much better position than any other large central bank. It's and uniquely positioned in my view. It is not like the US Fed, which is having to drive in the fog, as the Fed mentioned, nor does it have a threat of hostile takeover or a political interference in monetary policy. And if you look at some of the other central banks, inflation is not fully under control. Wherever it is, the growth is very, very uncertain. So I think the RBI, in fact, is in a much better and unique position. But having said that, I think there are two uncertainties that the RBI has to really deal with. And should it really preserve policy buffer and elongate the rate cycle? And the first one, the uncertainty, is global. And the trade deal is still a pie in the sky. We don't really know when and what will happen. Domestically, there is a degree of fiscal uncertainty. We will be moving to new fiscal anchors, right? Like debt to GDP instead of the fiscal deficit that people have followed. So there is a degree of uncertainty after years of responsible budget making. And also the fisc is reaching the limits of strategy of fiscal consolidation. The other one is we will have data recast going forward. So from February, we will see GDP, inflation, and later on IIP really being recast, which will make the windshield foggy and also the rear view mirror probably as foggy. So it might make some of the steps or policy measures look incongruent. So in my view, net, I think we need to really watch out for the stance. I think it should remain unchanged. The other, and probably more important, is the language or tone and cues on liquidity and FX. We are seeing what's happening to the rupee. And also we saw during the last policy and recently, the kind of deregulation and debottlenecking that the RBI has been doing. I think that will really be more important. We will certainly see growth getting revised up and the CPI being recast downwards by 50 to 70 basis points lower than 2%. But the real question is, should we be looking at October data while setting policy for the future? Or should we be looking at April, June kind of inflation numbers where it is likely to come up to 4% odd? In terms of growth, should we be looking at the 8.2, which has happened in Q2, or going forward, where growth is likely to soften a bit, along with the two uncertainties that I mentioned? So back to you.
Sure, no, Hitesh, point taken. Hitesh, let me come to you. Inflation, growth, rate, and stance. Your take.
So first of all, the previous speaker has summarized it very well. But I would like to say that the current growth inflation dynamic doesn't allow the RBI to cut rates. But if you look at the nature of this regulator, the central banks are forward-looking institution. So basically, looking at the softer patch of growth in the second half, a rate cut is justified. But the previous speaker has not touched upon the point that the yields will harden further if the regulator doesn't look at the policy tone. I think that the regulator should guide the markets that there is still policy space for further rate cut, or the regulator would come to support growth if there is a need. Hence, the appropriate policy action would be to whether or not they cut the rate or not, they'll have to look at the policy tone. A dovish tone with a rate cut would be more appropriate here.
Okay, a dovish tone with a rate cut. Uh, Sachidanand, let me come back to you. With regard to just the fact that you've got growth at 8.2%, much above estimates, and GST rate cuts likely to happen, do you believe that growth will surprise on the upside, and your reasons why you feel that we might see a bit of cool off going into H2? Is that purely because of the higher base?
So if you were to look at the trajectory on growth, clearly it's surprised all economists and forecasters. And if I were to put it in this manner, economists have been missing their forecast in 2025 on growth and inflation, like Columbus missed India, right? But going forward, I think it's very clear Q3, we will see the growth momentum being maintained. So you will see some uptick or some more surprise. But if I were to look at, say, H1 versus H2, growth is likely to come off a bit. And if you look at most forecasters, their numbers are 6 to 6.5 corridor. That will bring the growth still to a decent north of 7% for the entire fiscal year. So having seen the kind of growth in H1, because the deflator is going to normalize a bit, I did mention that even RBI's forecasts are going to be moving closer to 4% in the say middle of 2026, and that by itself is likely to bring or really normalize the real GDP growth. I think the key number to watch is also going to be the nominal GDP growth. We need to see some normalization over there, because if you look at 8 to 9% nominal GDP growth, and then you then build in a 4-5% rupee depreciation, India's growth differential is not very conducive for capital inflows, and I think that is something that we need to watch out for.
Hitesh, from a rupee perspective, that does that also warrant the fact that a rate cut could well continue to pressure the rupee? Uh, just also trying to get a sense from you that how linked is the RBI to US policy in your opinion?
So first of all, the monetary policy doesn't, the currency management doesn't come under the purview of MPC. So we should not expect any action, rate action or policy action which is addressed toward looking at the currency depreciation. But a rate cut would definitely bring down the interest rate differential and add more to the pressure to the rupee. On the positive aspect, next week there's an FOMC meeting, and the futures market is expecting there's a 80 to 85% chance that there will be a rate cut. So a rate cut by the Fed should take care of the interest rate differential between India and US, and that to some extent should cushion the rupee from further depreciation. But the overhang, major overhang remains the non-conclusive finalization of trade deal between India and US. That will continue to remain. Secondly, FII's selling has been intensified. So if you look at the figures in the 2025, leave aside 1 or 2 days in December, we have seen intense selling by FIIs. It's to the tune of $8 billion.
Okay, Hitesh,